Welcome to Harvest Financial Advisors Quarterly Update. I'm Marc Henn, CEO and founder, and this video update is for the quarter ending June 30th, 2026. In today's update, we'll review what we saw over the past quarter in the U.S. stock market and broader economy, and then talk about what we think is ahead for the remainder of 2026 and into 2027. We'll also cover why we believe the economy can continue expanding through 2028 while acknowledging a period of slower growth ahead, and how we're thinking about portfolio risk in the context of expensive valuations, concentrated equity leadership, and potential interest rate headwinds. It's been an interesting quarter. From a market perspective, equity markets closed higher, showing resilience even as investors weighed a changing mix of economic signals and interest rate expectations. On the economic side, we saw some trends that matter for what comes next. Wage pressure has cooled somewhat, housing has remained under pressure, and inflation, while not looking like the dramatic post-COVID problem we saw earlier this decade, still remains something we watch closely. And even with those mixed signals, the bigger story is that the economy has continued to function well. Looking forward, we believe gross domestic product will continue to rise through 2028. That said, we expect the pace to be sluggish next year. So think of it less as a slowdown turning into recession and more as growth that's still present but not as energetic. A big part of that outlook is what's happening with the consumer. Even though we see a lower savings rate and wages, when adjusted for inflation, are now at lower levels than last year, the consumer is still spending. We expect continued growth in retail sales for the remainder of 2026 and into 2027, albeit potentially entering a slowing growth period. And it's important to note who's driving that spending. Right now, the growth appears more supported by higher net worth individuals and families, while the working class has become less of a driver of the economy than it used to be. And remember again, consumer spending makes up roughly 2/3 of overall GDP. So as the consumer goes, much of the economy follows. Also, as investors have seen their wealth grow in recent years, the implication is that they have enough to continue spending despite elevated prices, even as others that are not investors may feel the pinch. This wealth effect is the foundation underpinning both the demand and the resilient nature of consumer spending today. And speaking of foundations, happy birthday, America. As we celebrate the semi-quincentennial, that's a mouthful, semi-quincentennial of the signing of the Declaration of Independence, it feels like a good moment to remember that long-term strength has always been part of the American story. While we all can point to areas where we want to see improvement, the celebration goes beyond political parties and differences and looks at the heart of one of the greatest experiments ever undertaken. So a toast to Uncle Sam and the next 250 years. Now back to the markets. Even though we expect continued economic growth, we want to stay grounded regarding where we are at in the business cycle. Markets are expensive by almost all measures, and they don't always traverse the same course as the economy. Because of this, and because current valuations leave little room for error, we have reduced the volatility within our equity portfolios purposely. We did that to address the risk that markets can move more sharply than the underlying economy suggests. Now, if you have questions about this, please ask your advisor. We want every client to understand not just what we're doing, but why we're doing it. Now, what could challenge this picture? One potential headwind is the Federal Reserve standing pat on short-term interest rates or signaling they might even raise rates. Either way, that can tighten financial conditions and influence stock valuations. We're also watching the bond market as bonds can send signals to stocks. For example, if the 10-year Treasury yield moves higher, it can be a signal that inflation concerns are resurfacing. My trouble zone for this would be the 10-year Treasury yield around 4.7% or higher, and more importantly, if it stays there for a period of time. That persistence matters. Another potential headwind we're watching is concentration in the S&P 500. According to JP Morgan, as recently as 2015, the 10 largest U.S. stocks represented about 17% of the index market cap. Today, it's roughly 40%. Now, this in and of itself is not automatically a problem, but the current circular structure of AI capital spending and the lack of significant revenue from said spending is something we think is worth paying close attention to. And it's one of the reasons we reduced portfolio volatility to help manage the risk of sudden changes in leadership. Now, on inflation, we do not see a return to post-COVID inflation, which was primarily driven by supply-side issues, but we do see inflation as something to keep an eye on. We may see more inflation slowly rise over the next year, but factors like a weak housing market and lower wage pressures should help keep it somewhat under control. Additionally, a large part of the recent rise in inflation can be attributed to the spike in oil and gas prices, which we assume will retreat, as they have done of late, and stay at a reasonable level. So, to summarize, we expect GDP growth to continue through 2028, with next year likely feeling more sluggish than this year. The consumer remains active, especially supported by wealthier households, and despite the negative news headlines and lower income households feeling squeezed, we expect corporate earnings and economic growth to persist. At the same time, markets are expensive, leadership is concentrated, and there are real potential headwinds, particularly rate expectations and bond yields. That's why we're managing risk and reducing volatility intentionally in our equity portfolios. That's what we see for the quarter and what we're watching into the rest of 2026 and beyond. If the economy remains supported and inflation stays contained, growth can continue. But because markets may react strongly to rates and inflation signals, we're staying disciplined and preparing for volatility rather than assuming a straight line outcome. If you have any questions, please do not hesitate to contact our office, and as always, we thank you for your trust.